Unrealized gains and losses in corporate taxation, accounting implications. In the course of a business's operations, it is not uncommon for the value of assets or liabilities to fluctuate. These changes in value are often reflected in the financial records, even when no actual transactions have taken place. The most frequent examples of such fluctuations include the revaluation of assets on the balance sheet, as well as changes in the value of foreign currency holdings or loan liabilities that are denominated in foreign currencies, which may fluctuate due to movements in exchange rates. These changes in value can have significant implications for tax calculations, particularly in terms of unrealized gains and losses. It is essential to understand how such fluctuations are treated in the context of corporate tax and their impact on a business's taxable income. Below is an in-depth discussion of the concept of unrealized gains and losses, their potential tax implications, and the requirements under the corporate tax law. 1. The nature of unrealized gains and losses. Revaluation of assets. A business's assets may undergo revaluation from time to time, particularly if the value of the asset changes due to market conditions or improvements made to the asset. For example, real estate holdings, investments, or other fixed assets may appreciate in value, but these gains are not considered realized unless the asset is sold or transferred. Similarly, foreign currency holdings or foreign currency-denominated loans are subject to fluctuations in exchange rates, which can result in changes in the value of these assets and liabilities. These changes, though technically representing gains or losses, are not realized in the traditional sense of the term, as the asset or liability has not yet been disposed of or transferred. Unrealized gains. An unrealized gain occurs when the value of an asset increases, but the asset has not been sold or transferred. For instance, if a company owns shares in another company, and those shares increase in value, the company may show a gain on its financial statements. However, since the shares have not been sold, the gain remains unrealized. Unrealized losses. Conversely, an unrealized loss arises when the value of an asset decreases. For example, if a business holds foreign currency that depreciates in value relative to the UAE dirham, it incurs a loss in terms of its financial reporting. However, this loss is not realized until the currency is actually exchanged for another currency or used to settle liabilities. These unrealized gains and losses are part of the business's financial statements, reflecting the changes in the market value of assets and liabilities. However, while these changes affect the company's financial position, they do not always result in actual cash flows that could be used to settle tax liabilities. This presents a challenge in terms of tax compliance, as businesses may face potential tax obligations on gains or losses that have not been realized in a conventional sense. 2. Tax implications of unrealized gains and losses. Taxation of unrealized gains. Under the corporate tax law, taxable persons are required to include both realized and unrealized gains and losses in the calculation of their taxable income. This is necessary to ensure that the tax base reflects all changes in the financial position of the business, regardless of whether those changes have been realized through actual transactions. For example, if a business holds an asset, such as real estate or stocks, that has appreciated in value but has not yet been sold, the appreciation will be recorded as an unrealized gain. While no cash has been received from the asset, the business is still required to account for this gain in its taxable income for the relevant tax period. However, a key consideration is that while unrealized gains are included in the tax calculation, the business may not have the cash necessary to pay the tax liability associated with the gain. This situation can be problematic, particularly if the asset remains unsold or if the appreciation is not liquid. As a result, businesses may find themselves facing tax obligations despite not having the actual funds to cover these liabilities. Taxation of unrealized losses. Unrealized losses are similarly included in the calculation of taxable income if they have been recorded in the company's financial statements. For example, if the value of a foreign currency holding decreases or an investment loses value, the business must account for the loss in its tax return, even though no actual transaction has taken place. This creates a potential tax benefit in the form of a deduction from taxable income, which may reduce the overall tax liability for the business. However, like unrealized gains, unrealized losses do not necessarily reflect a business's actual cash flow position. Therefore, even though the business has incurred a loss on paper, it may not have enough liquidity to offset the tax consequences of such a loss. 3. Realized versus unrealized, tax base and income recognition. The fundamental principle behind the taxation of unrealized gains and losses is to ensure that the tax system remains neutral and comprehensive in capturing a taxable person's income, regardless of whether that income is realized. The key issue is whether such gains or losses are included in the income statement of the business and will eventually be recognized for tax purposes. In practice, businesses must include all unrealized gains or losses that are recorded in their financial statements in the calculation of their taxable income, provided that these gains or losses will not be recognized in future periods. If an unrealized gain is expected to be realized in the future, for example, if the asset is likely to be sold or disposed of, it should still be considered in the taxable income for the period in which the change in value occurred. For example, a company that holds foreign currency that has appreciated in value will need to account for that unrealized gain as part of its taxable income for the year, even if the company has not yet sold or exchanged the currency. Similarly, if the company has incurred a loss on foreign currency holdings, this unrealized loss must be reflected in the tax calculation for the period. 4. Practical considerations for taxable persons. Cash flow considerations. One of the challenges of accounting for unrealized gains and losses in the tax calculation is the potential mismatch between tax liabilities and actual cash flows. If a business experiences significant unrealized gains, it may be required to pay taxes on those gains even though the company has not received any cash from the asset appreciation. To manage this issue, businesses must ensure they have appropriate cash flow planning and tax provisions in place. This could involve setting aside reserves or arranging for financing to cover potential tax obligations related to unrealized gains. Record keeping and documentation. To ensure compliance with the corporate tax law, businesses must maintain comprehensive records of all unrealized gains and losses, including the changes in value of assets and liabilities, the basis for any revaluation, and the underlying factors driving these fluctuations, such as changes in market conditions or exchange rates. Proper documentation is essential, as the Federal Tax Authority, FTA, may require detailed information to support the calculations made for taxable income. This includes supporting evidence for unrealized gains and losses reflected in the business's financial statements, ensuring transparency and accuracy in tax reporting.